Hello, everyone. Hope you're all doing well. I want to talk about a potential trading idea in CVS. So, one of the things I've learned over the years is that the best traders kind of let the market tell them what to do. They don't have these preconceived notions. So, at Stock Market Jobber, we spend a lot of time just going through the markets looking for things that might be of interest. Now, CVS blew up the other day, all right, and it sold off big. But this is what I want to show you. There's this concept called market memory. And basically, what it refers to is the fact that there's certain price levels that are more important than others. That's just how it is in the markets. Sometimes we know why, sometimes we don't. But if we look here at CVS, you can see a lot of examples of this. For example, the 111 level was resistance in July and August, way back in 2015. Then it became resistance again in February of 22. The $83 level was resistance for 2 years. The 76.50 level was resistance for a year back here. And then last summer, it became resistance again. So, market memory, a level that is important, can retain its importance for a long time. And they can switch back and forth between resistance and support. People sell at resistance, and when the price goes higher, a lot of them say, I made a mistake. If it gets back to my level, I'm going to buy my shares back. So, you get these remorseful sellers placing buy orders. And if there's enough, then the level that was resistance becomes support. Support can become resistance because remorseful buyers, people buy and the price goes lower, and they say, if it gets back to my price, I'm going to get out at break even. So resistance can become support because of seller's remorse. Support can become resistance because of buyer's remorse. So that brings us to where we are today. Look at this $52 level. We'll just go back to the longer term chart here. 52 was support from February of 19 through July of 19, and then in the COVID crash in March of 20. Look at where CVS is now. Big sell off, getting kind of close to this 52 level. Another thing I want to point out here is we talk about oversold, right? Oversold is a term that refers to a momentum of a market. Oversold means the thing has been really beaten down and it's trading below what would be its typical or usual range. The sellers have been really emotional and aggressive. This is the most oversold CVS has been on based on this indicator since the market crashed in 1987. So when you get something that's at a historic level, you got to pay attention. These oversold conditions are going to bring buyers into the market because they're going to be anticipating a reversion to the mean or a move higher. Support is a large group of buyers by definition. That's what it is. If a market's going lower, there's not enough demand or buyers. If it stops, then we know there is. All right. So sometimes some of the buyers who create the support start to look around and notice, oh, gee, there's other buyers coming into the market here. I think I better increase the price I'm willing to pay, or else the sellers will go to someone who's willing to pay a higher price than me. And it starts a bidding war. And the buyers jump ahead of each other and they drive the price higher. This is why we tend to rally off of support. So I don't think I would get in here yet. I would probably wait for it to get a little bit closer to 52. Then if the thing starts to rebound, then that's when I would jump in. I'm not going to try to catch the exact bottom, but once I get a little bit of conviction that a reversal is going to happen or is underway, that's when I would get in there. Okay, thanks everybody. I will talk to you soon.